Nearly 30% of retirees are making expensive mistakes with their required minimum distributions. And with penalties as high as 25% of every dollar you miss, these errors can cost you thousands. Today we are going to break down everything you need to know about RMDs in 2026 so you can avoid those costly mistakes. Welcome to the Retirement Classroom. If you are new here, we publish deep dive retirement education videos every week. Hit that subscribe button so you do not miss a single one. Before we get into the details, a quick note. This content is for educational purposes only and should not be considered individual financial guidance. Everyone's situation is different. Please consult with qualified financial professionals before making investment decisions. If you are looking to speak with a retirement professional about your unique situation, scan the QR code on screen or check the link in the description. So what exactly is a required minimum distribution? An RMD is the minimum amount you must withdraw from your tax-deferred retirement accounts each year once you reach a certain age. The IRS does not let you defer taxes on this money forever. At some point, they want their share. RMDs apply to traditional IRAs, SEP IRAs, simple IRAs, 401k plans, 403b plans, and most other employer-sponsored retirement plans. The key exception is Roth IRAs. If you are the original owner of a Roth IRA, you never have to take required minimum distributions during your lifetime. And as of 2024, thanks to Secure 2.0, Roth 401k and Roth 403b accounts are also exempt from lifetime RMDs. Now let us talk about the age when RMDs begin. This has changed several times in recent years. Originally, the starting age was 70 and a half. The Secure Act of 2019 pushed it to 72. Then, Secure 2.0 in 2022 raised it again to 73. And there is one more change coming. Starting January 1st, 2033, the RMD age will increase to 75 for anyone born in 1960 or later. Here is how to figure out your specific RMD starting age. If you were born between 1951 and 1959, your RMD age is 73. That means you will start taking RMDs between 2024 and 2032. If you were born in 1960 or later, your RMD age is 75. You will not need to start RMDs until 2035 or later. This gives younger retirees additional years to let their tax-deferred accounts grow before mandatory withdrawals begin. Understanding deadlines is critical because missing them triggers penalties. Your first RMD has a special deadline. You must take it by April 1st of the year following the year you turn 73. After that first year, every subsequent RMD must be taken by December 31st. Here is where people get tripped up. If you delay your first RMD to that April 1st deadline, you will end up taking 2 RMDs in the same calendar year. Your delayed first year RMD plus your second year RMD by December 31st. That double distribution can push you into a higher tax bracket and trigger Medicare RMD surcharges. Let me walk you through a real example. Say you turn 73 in 2026. Your first RMD is due by April 1st, 2027. But your 2027 RMD is also due by December 31st, 2027. So in 2027, you could have 2 full RMDs hitting your taxable income. For someone with $500,000 in traditional IRA accounts, that could mean roughly $37,700 in distributions in a single year instead of $18,800. That is a massive difference for your tax bill. Now let us talk about how to actually calculate your RMD. The formula is straightforward. Take your total traditional IRA balance as of December 31st of the prior year and divide it by a life expectancy factor from the IRS Uniform Lifetime Table. For 2026, you would use your account balance from December 31st, 2025. Here are some examples using the Uniform Lifetime Table. At age 73, the divisor is 26.5. So if your balance is $500,000, your RMD is $18,868. At age 75, the divisor is 24.6. A $500,000 balance means an RMD of $20,325. At age 80, the divisor is 20.2. That same balance produces an RMD of $24,752. At age 85, the divisor is 16.0. Now your RMD is $31,250. Notice the pattern. As you age, the divisor gets smaller, and the RMD percentage gets larger. At 73, you are withdrawing about 3.8%. By 85, it is 6.3%. This accelerating withdrawal rate is exactly why the IRS created RMDs. They want to ensure all that tax-deferred money eventually gets taxed. There is an important exception to the uniform lifetime table. If your spouse is the sole beneficiary of your IRA and is more than 10 years younger than you, you can use the joint life and last survivor table instead. This table produces a larger divisor, which means a smaller RMD. It is one of the few situations where the IRS gives you a break on how much you must withdraw. Now, here's a rule that confuses many people: the aggregation rule. If you have multiple traditional IRAs, you must calculate the RMD separately for each account. However, you can take the total combined RMD from any one account or any combination of accounts. This gives you flexibility in choosing which account to draw from. But this aggregation only applies to traditional IRAs. Employer plans like 401k accounts cannot be aggregated with each other or with IRAs. Each 401k requires its own separate RMD. You cannot satisfy your 401k RMD by withdrawing extra from your IRA. Let us talk about what happens if you miss an RMD or take less than the required amount. Before Secure 2.0, the penalty was a brutal 50% of the shortfall. That has been significantly reduced. The current penalty is 25% of the amount you should have withdrawn, but did not. And it gets even better. If you correct the mistake within 2 years by taking the missed distribution and filing Form 5329, the penalty drops to just 10%. Say you were supposed to take a $20,000 RMD but forgot entirely. Under the old rules, you would owe a $10,000 penalty. Under current rules, the penalty is $5,000. And if you catch the error quickly and correct it within 2 years, it drops to $2,000. Still painful, but much more manageable. The IRS may even waive the penalty entirely if you can show reasonable cause and that you took corrective action. Now let us get into the strategies that can help you minimize the impact of RMDs on your taxes. Strategy number 1 is Roth conversions. Before RMDs begin, every dollar you convert from a traditional IRA to a Roth IRA reduces your future RMD base. Roth IRAs have no lifetime RMD requirement for original owners. So if you are in your 60s and have not yet reached RMD age, consider converting a portion of your traditional IRA each year. Fill up the lower tax bracket strategically. The tax you pay on conversions now could be far less than the tax you would pay on forced distributions later. Just remember, you must satisfy your current year RMD first before doing any Roth conversion. The RMD itself cannot be converted to a Roth. Strategy number 2 is qualified charitable distributions, or QCDs. If you are age 70 and a half or older and you make charitable donations, QCDs are one of the most tax-efficient strategies available. A QCD allows you to transfer money directly from your IRA to a qualified charity. In 2026, the limit is $111,000 per person. The distribution counts towards your RMD, but it does not get added to your adjusted gross income. That is powerful because it means the distribution does not increase your tax bracket. It does not trigger higher Medicare IRMAA premiums. It does not increase the taxable portion of your Social Security benefits. You get the full benefit of satisfying your RMD without any of the tax consequences. The key rule is the money must go directly from your IRA custodian to the charity. It cannot pass through your hands first. Strategy number 3 is timing your first RMD carefully. As we discussed, you can delay your first RMD to April 1st of the following year. But in most cases, it is better to take it in the actual year you turn 73. This avoids the double distribution problem and keeps your taxable income more evenly spread across tax years. Strategy number 4 is using RMDs to rebalance your portfolio. Since you have to take the distribution anyway, use it as an opportunity to sell overweight positions. If your stock allocation has grown beyond your target, take your RMD from the equity portion of your portfolio. This turns a mandatory withdrawal into a portfolio management tool. Let us put this all together with a complete example. Meet a hypothetical retired couple. Both are 73 years old in 2026. He has a traditional IRA worth $400,000. She has a traditional IRA worth $300,000. He also has a 401k from a former employer worth $200,000. His IRA RMD is $400,000 divided by 26.5, which equals $15,094. Her IRA RMD is $300,000 divided by 26.5, which equals $11,321. His 401k RMD is $200,000 divided by 26.5, which equals $7,547. Their total combined RMDs for 2026 are $33,962. Now, if they use a QCD strategy and each donate $5,000 to charity through qualified charitable distributions, they satisfy $10,000 of their combined RMD obligation without adding a penny to their taxable income. Their taxable RMD drops to $23,962. That is a meaningful reduction in their tax bill, and it keeps them further from IRMA thresholds. Here are the key takeaways. RMDs are required withdrawals from tax-deferred accounts starting at age 73 or 75, depending on your birth year. Your first RMD deadline is April 1st of the following year, but taking it early avoids the double distribution trap. RMDs are calculated by dividing your prior year-end balance by your IRS life expectancy factor. The penalty for missed RMDs is 25% but drops to 10% if corrected within 2 years. Roth conversions before RMD age reduce your future mandatory withdrawals. QCDs up to $111,000 in 2026 satisfy your RMD without increasing your taxable income. And remember, each 401k requires its own separate RMD. You cannot aggregate employer plans. If this breakdown helped you understand required minimum distributions, hit that subscribe button and turn on notifications so you do not miss our next deep dive. We publish new retirement education every week.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.